One of the overarching things I want to talk about today is this concept of ecosystem versus ecosystem that I'll explain in a little bit more detail in the coming slides. It's really a reflection of my perspective on early stage company building and what makes it successful that I would encourage you all to think about how it applies to your situations. But let's jump in. My name's Tyler. I'm the co-founder and general partner at Baukunst, which is a collective of creative technologists that I'll describe a little bit more. We also have a VC fund and back entrepreneurs at the very beginning of their company building journeys. Just some quick personal background so you kind of understand where I'm coming from. And I think this is also helpful as you think about your own personal journey, because I think mine's had some interesting twists and turns along the way and is fairly non-traditional for somebody that's in a full-time investing role now. So I got a chance to work with Helen back in the mid 2000s at Apple. I was part of the first generation iPhone team when I was there and was managing the full iPod product roadmap for a while too. It was a really exciting time to be at the company when Steve was still around, and we were really operating like a startup inside the larger company. Very dramatic redesigns of the products every year that needed to be on a kind of laser focused cadence to be ready for the holidays every year. Most of these, we would completely redesign the hardware, software of these products, and ramp up of many hundreds of thousands of units a day at the factory that we would kind of get up to speed to make our quotas for the holidays. So amazing time to work there, and was a really formative part of my career. That really taught me how to do high volume products, to really do design-led groundbreaking visions for the products, and kind of had this like feeling of a startup inside the larger company. I went on to be a partner at this digital agency based in New York called Fictive Kin. We were mostly focused on doing web apps and mobile apps, but in a partnership model where a lot of the projects we would work on would, once we launched them and if they gained some traction, we would often hire a sustaining team and raise venture money to actually spin that out into a standalone company. So really kind of where I cut my teeth in the startup world. It was also interesting that was an internationally distributed team and kind of gave me a really strong taste of remote work back then. That led me to moving back to the West Coast, where I was part of the founding team of a company called Pearl that was a venture-backed startup in the automotive technology space. I really got to be there from the founding of the company through all of our funding rounds, got to kind of serve at the board level, and really gave me exposure. After that, I made the jump to getting into venture. I worked at a firm called Bolt that was very focused on the intersection of the digital world. We did lots of investing in early stage connected device companies. And I actually got into venture because of their unique investment model at the time, where they had a full-time engineering team that would get plugged into portfolio companies and kind of help them hire and develop their products over time. So I came in as a VP of engineering, but over time really evolved into just being more of a normal partner track member of the investment team. So got more involved in sourcing investment opportunities, working on due diligence and the negotiation process, and then supporting companies on the back end. And then just last year, I launched a new fund called Baukunst. That's a German word that means the art of building, with some of my partners from Bolt that I'm excited to tell you guys a little bit more about. We just announced the fund in the spring that we were kind of out in market and we started to do some first investments. And just a couple of weeks ago, we announced the final close of the fund. So it's a $100 million fund that's focused on leading pre-seed investments. I'll go into that a little bit more in different aspects along the presentation, but that's a super high level overview. Because we invest so early, we really define our investment thesis and what we invest in more as a who than a what. And so this group of founders that we describe as creative technologists we think the people best poised to build big companies will have a meaningful impact in the world. I'm kind of this, three-circle Venn diagram of design, engineering, and business. And it's really important to me, the intersection of all those things and how they apply to my day-to-day professional career now. I love being an interdisciplinary person. I like to invest in interdisciplinary people. And so it would encourage you to look for those kind of interesting connections in your own background and really embrace those. It's really important to blend deep expertise with a horizontal approach and viewpoint that brings in, I think, inspiration from other parts of your life and to your day-to-day work. We've really specialized in doing some groundbreaking first-generation technology products. We were the first institutional investors in this company, Tonal, that makes an at-home strength training product. We also do a lot of stuff in how things are built as well, too. So lots of investments in collaborative design software. If you're familiar with tools like SolidWorks, Onshape, Revit, and the architectural space too, the partnership at Baukunst, we're all kind of first institutional investors in all those companies. So we are very deeply interested in how engineering teams and designers collaborate, how products are manufactured, and how the supply chain is undergoing digital transformation right now. A big part of that is also keeping sustainability in mind. So a lot of what we do is looking at how both personal health and sustainability can actually be accretive to business models and can be the foundation for big companies. And last but not least, like companies themselves are very interesting to us. And so a lot of the folks we work with have very progressive HR policies, everything from, salary transparency to embracing remote teams to following best practices for hiring a diverse workforce and supporting them and being successful in their careers. So that's a big part of what we do as well. We have a kind of a unique perspective across a portfolio of companies that we invest in and can help cross-pollinate best practices and just be cheerleaders for people doing things differently in a more kind of aspirational way. And that's all in our name. So like I said, Baukunst means the art of building. If you're familiar with the Bauhaus, the initial prefix Bau is building. It's the same root. Kunst means art or craft. And for us, that really, encapsulates what it looks like to build companies from early stages. So let's talk about what that means. I wanted to kind of zoom in on the early stage funding landscape and talk about kind of what's going on right now. So one thing I would say, I'm speaking from a very VC-centric perspective. I would emphasize the fact that not all VC funds are made the same, and VC is just one tiny slice of the different funding mechanisms you have for starting a company. So we'll just talk through some of these buckets at a high level. So has been an explosion of early stage VC funds, both at kind of what's called pre-seed or seed these days, that are relatively small, under $100 million. They have become hyper specialized. You can find some funds that only do sustainable packaging companies based in New York or something that are hyper specialized. And I think those can be very helpful for some specific founders, but are very kind of niche in their knowledge, but have really been part of the engine for this explosion of funds that we've seen. Just because they're so hyper specialized, a lot of capital is chasing those and can really diversify their investment portfolio based on that hyper specialization. We've been kind of in a bull market for quite some time that maybe we're not in anymore, which is interesting. But there's lots of kind of funds that were raised and kicked off in the bull market. And I think the quality can vary pretty dramatically from firm to firm. And because there's so many new funds, it's a little bit hard to point to track records sometimes. And so it's an important thing to kind of dig into that bucket. Accelerators are interesting to talk about too. Their usually main pitch is that there's a network and a educational curriculum that is really a superpower that's in addition to just the money itself. I think they can be really great in kind of bootstrapping people's networks and communities. But I think the downside, the other side of the coin, is that sometimes there can be almost too rigid of playbooks that are applied to the kind of cohorts of companies as a whole, and really sometimes lack the bespoke advice that every company needs for their own context. Oftentimes, accelerators are also incentivized to focus on quantity over quality of the companies going through the program. And so even for us, as we're kind of sorting through companies coming out of accelerators, it's very difficult to sift through the large number of companies out of them. It's a little bit more of a needle in a haystack situation where there's a truly great company coming out of an accelerator. A lot of the really excellent companies and the really excellent teams are able to raise money through other methods and sometimes get better deals out of it too. So there can sometimes be a selection bias there that I think is going to be aware of. There's also lots of legacy VC funds, huge, multi-billion dollar funds that have existed for decades that are trying to be active earlier and earlier in companies' life cycles. I think they're really interesting and absolutely have a track record of building big companies. But I think the trade-off for an early stage investor is how much of the partner's attention are you really going to get? I think they, just by the nature of the business and the size of their investments at that point, often focus on the slightly larger stage rounds, and the initial investments at pre-seed where they might be kind of dipping their toe in the water might end up being just money and a little bit less of the really active company building support. And then the last group, angels, I want to talk about are usually individuals that are kind of investing just themselves or out of a family office. I think the really great thing is a lot of those angel investors come from an entrepreneurial background themselves. And so they can provide really specific company building advice, and you can kind of put together a cohort of these that are especially relevant to your company and can be really great to effectively have advisors that really have skin in the game and can be helpful. The downside is that's usually not their full-time job. And so, you're getting help from them, but it may be less than you wish you could get. So that's an important thing to keep in mind. There's also tons of other funding sources as well, government grants, crowdfunding, et cetera. But I sort of see these four as the big main buckets. And my fund, Baukunst, I'd put the top left corner there as being a kind of an emerging fund. The labels that are applied to early stage fundraising have changed in somewhat like arbitrary ways, but I think are really important for you to understand. The first funding round that a company raised used to be called seed, and usually were fairly small rounds, usually under $1 million, even 10 years ago. But we've really just seen an explosion in what that means these days. And really what we call seed today is what we would have called a Series A investment even 10 years ago. And so because of that, the round sizes have been going up and up and up. The expectations for how far along the company needs to be have also been exploding. And so as a result of that, what you need to get to a successful seed round has fundamentally changed. So where you used to be able to raise maybe a couple $100K here or there from angels or friends and family or an accelerator, that's really not enough anymore. And so we've seen this pre-seed stage really grow up as a discrete fundraising round for people, where they oftentimes will get a lead investor, often raise well north of $1 million and give themselves 18 months, 24 months of runway to get where they need to. Because even in 2019, over 2/3 of companies have been generating revenue by the time they raise seed. So that means you already have to have like fully developed product. It already needs to be in market. There already have to be customers that have been using it long enough to reflect on how the product's been performing. And that's really hard. And so you need a relatively old, mature company to get there. So this is really the place we've been playing in specifically. I think this is relevant for you if you're thinking about raising a round. You don't want to say that you're raising a seed round typically right out of the gates, because there's going to be a mismatch of maturity versus what people are expecting to see at that stage these days. And also it's important to know to kind of size your pre-seed raise the right way, where you might have used to think that it was going to be okay just to kind of raise some money in a piecemeal way and that would get you there. Sometimes that's not going to be enough. And so you should really think about it as maybe being a slightly larger discrete raise at the beginning of your journey. That's not a one size fits all piece of advice, but I think what we're tending to see to be more of a healthy fundraising profile for founders these days. So I usually get a lot of questions around like, well, what does it look like? Like, what do I have to have done to have a healthy company and be ready to raise pre-seed? So just to talk through like what we expect and what we don't expect. We really invest in founders. They need to be excellent. And that's a big part of who we're backing. We don't expect you to have a full team. We're often involved in helping structure org charts, decide who the right first hire should be, sometimes help with the recruiting process. That's kind of like the work that happens after you've raised a pre-seed round. And so you don't need all that in place. It's really important to have a large and timely market opportunity articulated. It's really just about how big can this be if it works. It's not yet about revenue. We don't expect you to have a product in market. In the same way, like we expect you to be able to really know your customer and articulate what a strategic beachhead market is. But we don't expect you to be growing and to be kind of like turning the crank on increasing, or to have a healthy customer acquisition funnel, et cetera. It's really just being able to say like, this is what we're about to do. Oftentimes people do have some proof of concept product though that really helps crystallize the product vision and something even we can try or demo. That's really helpful, but we don't really expect that to be something that's ready to ship yet. And oftentimes, like through the course of working with us at pre-seed, the product changes a fair amount and is really kind of developed to a more shippable level of quality for their first customers. We don't really expect you to be able to talk about engagement or real usage metrics yet, but we do expect you to be able to articulate what the value proposition is to your customers and to articulate why the product is architected the way it is and why it's a timely opportunity. We're really big believers in business model. It's not all about like get as many customers as quickly as possible and figure out how to make money with them afterwards. And so we really do focus a lot on the unit economics of a business. You should be able to like articulate what your business model is, how you make money, roughly, how much you would estimate your customers to be valued over time, how you might go about acquiring your customers, how much that costs, maybe benchmarked against other companies. Those are all extremely rough estimates to some degree, but really just like showing that level of rigor and focus on business model from day one is really important to us. But obviously, because you don't have a product out in market, you can't really talk about the real numbers yet. And so we don't really expect that. Another big thing around the plan for the business, a lot of times, companies will have 3-5 year revenue models. And I think those are kind of like fine, but there's so much noise in those. We honestly don't even really look at them. We really want to see a specific plan around just what are you going to do over the next 12, 18, 24 months. And for us, that usually looks like a month-to-month plan of how you're spending money, who you're hiring, what the company's achieving over time, and how that lines up with when you might need to raise money or not raise money next. It's really kind of zoomed in on the first handful of months that are really important. So for me, that's really at a high level, kind of the assets we typically see a company bringing together for fundraising at this stage. And so like, if you kind of have those things, you're ready. Like you don't actually need to wait much more to get out and fundraise these days. But also kind of like the whole aspect, 2019 on some of those slides earlier, and the world has changed a lot since then, obviously. We're in a little bit of an economic downturn right now. It's hard to say whether we're at the bottom or there's kind of worse times ahead of us. Only time will tell. But one thing I do know is that it's maybe the best time ever to start a company. I think going to work at a larger company right now, I think they're going to tend to be more slower moving and conservative than they have been in the past. And it's a great time to invest in yourself and start something new. So people are still writing checks. There's lots of funds out there that have already raised funds that are deploying capital. And it's fairly easy still to raise money to start something, but the bar is even higher for later stage companies now. And so when you put all that together, it's more important than ever to have a healthy amount of runway for your company. There's a bunch of ways to do that. Like you can have a leaner operating plan, you can have a shorter term path to revenue, or you can just raise more money up front. I'm going to jump in now to a question I get a lot, which is, what do we look for when we're evaluating early stage companies? And like I said, we're usually the very first institutional investor in the companies we're backing. So it's extremely early on. And so there's many things that go into the decision-making process, but I really wanted to highlight 3 high-level ones. The first of them is a large market opportunity. This is almost obvious, but I really want to underscore this point. Venture is definitely a hits made business. And so we're always trying to ask ourselves the question, if this works, how big could it be? We're actually not at first asking, like, what is the likelihood that this thing succeeds, or what is the risk that this thing fails? We ask those questions, but those are kind of secondary. The first qualifying question really is, if this works, how big could it be? We kind of like wild, crazy ideas. And oftentimes when we back founders, we're not saying that we're sure this is going to work. We're saying that, like, wouldn't it be crazy if this did work? And that's a fun part of the job. The way that gets talked about a lot is kind of some of these acronyms I have here, like TAM, SAM, SOM, which are total addressable market, serviceable addressable market, serviceable obtainable market. That's a little bit, you may have learned about those terms. If you don't know them, you should go look them up, because I think they're helpful concepts to think about and consider. They're a little bit too formulaic. Like I don't like expect to have a slide with 3 bubbles that get smaller all the time for every company that we look at. It's really about being articulate what your business model is and how that translates to a large market opportunity. For us, like it's really a qualifying point that your company might have a path to being over $1 billion valuation someday. That like works out to like roughly, with most kind of tech company multiples, to roughly be like $100 million a year recurring revenue business. So we usually look for some sort of like top down or bottoms up market analysis that really proves that point. And it's really just a hypothesis at this point too. Like most of the companies don't have revenue by the time we're investing. So it's definitely an experiment still, but that's a really important qualifying point. Like you really have to establish this very early on. Some people just talk about why their product is going to be clever, or how familiar they are with the technology. But if it doesn't make this point first, you're not really even excited about the product itself. And this is a really important qualifying point for us. The second thing is, like, we always ask ourselves, why now? There's a good chance if you're having an idea, there are other smart people having the idea at the same time. And that's usually like because of the fact that something changed in the world. Like the markets are fairly efficient at bubbling up solutions to problems that have existed before, if the building blocks of the solution exist. And so usually, like, answering why wasn't your idea a business already, why did that happen 5-10 years ago, is really important in understanding the strategy. And for us, that's usually not just one answer, but it's a number of different answers. For us in particular, like, we look at things both on the technology side of the spectrum and the demand side of the spectrum. So demand is really where it starts. And there's very interesting trends happening with generational change, with the shift in how work is done towards more remote collaborative work, some external factors like climate crisis and things like that. So there's lots of things that are changing markets themselves, like what people want, what they're willing to pay, what their priorities are for products. And then on the other side of the equation, there's technology. And those are the building blocks and the tools that we have to pursue those opportunities. And so everything from like what's happening with cloud computing, AI tools, Web3 crypto technology, the capabilities of our phones, and increasingly cheap and affordable sensors and compute. All those things are very interesting to us, but aren't really like necessarily the starting point of a great idea. And so we're always looking for these two things to collide. And oftentimes it's a couple of them together that make a really exciting opportunity, but a really important thing to articulate, ideally riding the confluence of a few of these waves. And for us, again, when we talk about our investment strategy as just anecdotally as a fund, we start with people, and the people that sit at the center of this Venn diagram are creative technologists for us. We think they're best poised to have the insight and the capabilities to pursue these opportunities. Good transition to the last one, exceptional founders. This is like probably the 80% of the investment decision is really on the quality and capabilities of the founders. Again, like we were saying, like if you're having this idea and you have a strategy that's at the confluence of these trends, like there probably are a handful of other people that are having the same idea. And we almost need to convince ourselves that you're the best team to back in attacking that. And so there's a lot in that, but really like it's not just being qualified that counts. It's really being the best to pursue that strategy. We're usually looking for a unique viewpoint that typically comes from some sort of earned insight that came from somebody's interdisciplinary backgrounds or something they accumulated by being in market. We usually lean on more about talents and abilities versus experience and expertise necessarily. So all of our companies are fundamentally doing something new. So people that have vision, that have experience building companies and navigating technical hurdles and funding hurdles and doing something new. We like to back people that learn quickly and are good at doing new things because that's what we're in the business of doing. People's just disposition is a key part of that too. Like we like people that bias for action, that iterate really quickly, that are collaborative, incorporate feedback from other people. All that has to be driven really by the mission of what you're pursuing and the impact it's going to have in the world. I think if you start by being purely financially opportunistic, you'll struggle to recruit teams and struggle to manage your own morale and the morale of the folks you do bring on board when times get hard. So really having that fuel to the fire that's impact driven is really important. We also tend to back founders that have a healthy financial mindset. There's a lot of startups that take a path of like hyper scaling and growth at all costs and figuring out the business model after the fact. We really like business models and a short path to revenue and people that are happy to keep their company at a reasonable scale and a lean operating plan while they debug their core business models before they scale it. So that's maybe one that's a little bit more about us than a general topic, but something we were really big believers in. There's a S up there in founders because we really do prefer complementary teams. It's rare that one person embodies all the skills and knowledge to run a great company. And so you usually need 2 or 3 people. And then the emotional support is really important. Running a startup can be hard, and it's nice to have trusted sounding board and colleagues that you're working with. And then last but not least, like this is just the seed of a big company. And so founders need to be not only great themselves, but attract great people. And so proof points around them building excellent teams in the past to be able to tell inspiring visions that we believe are going to be, centers of gravity for other exceptional people is a really important thing for us. And so this is actually like feeds into the kind of the title of the whole talk for us. Like I would say almost like the ethos or the mythology around startups and a lot of companies in general is really this idea of ecosystem where, a perfect idea comes fully formed from a founder's head and they, in an uncompromising way, push that ideal in the world and make it happen. And they have, recruit armies of teams to make their vision a reality. And I think an idea is very important and required, but is only a small part of actualizing something and making it exist in the world. And to do that, you really need a whole community of people that are advisors and early teams of many different disciplines. And your early customers and the community and culture you build around your company are really important. And so we really like to pick people that like embrace that ecosystem approach as opposed to ecosystem, because we think that they have the mindset to build a successful company. And for our fund specifically is actually to have a community of experts that are a little bit later on in their careers, maybe that are founders or subject matter experts in a number of different relevant areas that have expertise in like what is the most valuable skills and strategies for in the first couple of years of the company's lifetime. Really happy to have Helen as part of this group too, and really benefit from her guidance and expertise. But really, we want to build a fund in a community that is supportive of builders, building inspirational products, and that just requires a village. So in summary, like I would love to help you start something. Like there's an ask I have. If you yourself or know someone that's thinking about starting a company, that's our whole business. I'm always like here to be a sounding board for people to talk about like, is my idea good? Is the kind of DNA of my company something that's actually investable, like we talked about on the previous slides? I'm like very happy and spend a lot of time talking to people about that, even before it's like a pitch. And so feel free to reach out. You know where to find me if you want to talk about that. If you're interested in early stage companies, but maybe you're not ready to start one yourself, there's a lot of opportunities across the portfolio to get hired in an early stage company. I'd love to connect you with those. And one in particular is like Baukunst itself is hiring as well. So we do have a role open for an entry-level associate that's a partner track member of the investment team, which is a pretty rare and interesting opportunity. So if that's something that's interesting to you too, I'll have the link into the job description and you can get in touch there as well.